I am talking about a person who want to invest only 10 lakhs rupees, then also asset allocation is playing an important role. Because any person who is investing, first he need to see how much money he can invest for long term. And for long term, equity always suits to the requirement, considering he requires to achieve a particular growth related goal, and at the same time he doesn't require the money in short term, then he can very well put money into the equity side.
Hello and welcome to the show. Today we have with us Mr. Roop Bhootra, a chartered accountant and the CEO of investment services at Anand Rathi. He has over 25 years of experience with the capital markets. So it's no surprise then that we will be taking in his insights into the world of investing, understanding the different products that are out there and for different income levels. If you're a beginner investor, we'll also be taking in some tips on how you can begin and diving into the world of PMS and wealth management. All of this by glimpsing into the mind of this market veteran. Mr. Bhootra, an absolute pleasure having you with us today on Money TV. Thank you so much for joining us.
Thanks, Mubina, for making me part of this particular Money TV. So thanks a lot.
Well, we're hoping to get a lot of investment insights from you. But before that, I'd like to understand your own journey. How did it all begin for you? How did you begin in the world of the Indian financial markets?
I have started just after completion of my chartered accountancy. I have joined Anand Rathi Group, and it was just a beginning like anybody else who is doing as a fresh beginner. I was happy that I could see this particular journey from starting as a fresher and reaching to a position of a CEO in this particular group itself. Thanks because to the promoters also, who has given me lots of opportunity to work into different roles, different profiles into this particular organization, where I have started from just accounts, back office, operation part, then I moved to the business side, then moving from the business side to the product side. So it's a multiple thing which I was able to do when I have started with this particular organization. The total organization size was just 25 employees, and today with the group level, it's almost 5,000 plus team members. And with me currently a total team of almost 1,800 people.
So you have experience across all verticals in essentially investing. So we want to understand from that because you have that insight and and in the skin experience of into the world of investing. So tell us, what are the various investment avenues that are available to investors today?
In recent past, the market dynamics has changed a lot, especially post-pandemic. Thanks to the government initiative, thanks also to the, regulators, be it RBI, be it SEBI, be it IRDA. There are lots of product has been developed in recent past. And when we are talking about the overall the product basket which is available or investment avenues which are available, on broad theme, if I will say, always it was there, like I can say one side it's the equity side, second is the debt side, third is the real estate side, and fourth is your gold or silver. Okay, that's the precious metal. All these four types are the broad type, but in between, I can say with each of these asset class, there are multiple products which has been gradually came into this particular market. And there we are able to see that different category of the client based on the different risk profile. Now availability of products is amongst all these different asset class. If I will say in terms of the equity side per se, it was earlier long back, if I will say, it was just a direct equity, and that was also within the reach of a very limited people, and it was available to a, I can say, limited cities. I can say more specifically it was in metros or mini metros. But nowadays because of the digital transformation, those all, I can say, asset class now available at the tips of each and every people and in each and every city or even the small villages. In terms of equity side, one is, as I mentioned, one is the direct equity. Other than that, mutual fund, then ETFs, then it's the PMS, then it's a different sort of, I can say, structure product also, which are, I can say, Nifty linked structure product. So multiple different products has came into this particular market. If I will say on the debt side also, earlier it was only one product mainly which was going on long back, it was the bank FDs. And post that, it came to the different product where debt side also the mutual fund came, In terms of other than the mutual fund debt side, again the ETFs are there which are linked with the debt related thing. Again the structured product that has also came. Government securities are also nowadays becoming very, very popular. So different avenues came towards that side. On the gold or precious metal side also, the different avenues has came in terms of investment, where earlier it was only the physical gold. Now people can hold gold in demat form. People can hold gold in case of sovereign gold bond. So bonds can also be holded upon. So different asset class came into towards that side. And fourth one which I have mentioned, that is the real estate. There also earlier it was only the physical real estate, but now along with that the different product came. The REIT is there. Then there are different thematic baskets are there related to real estate funds. So different product basket came. So it's a universe of basket which are available.
I think investors are spoiled for choice, that's for sure. But sometimes this also complicates things for investors, and that's why your services are extremely important. There are many criteria we look at when deciding that, okay, what should a particular investor consider? There would be perhaps age, risk appetite, what their financial goals are, and also how much can they invest. And that can be decided basis your income or your investable money. So I want to talk to you about that. We're going to largely break up our cohorts into the different income levels. So let's start off with, let's say somebody who is just starting off to invest. So obviously they may have a smaller amount to invest, let's say less than 10 lakh rupees. How would you build a portfolio, and what are the products you'd recommend for such an individual?
You have very rightly asked in your question itself many answers. That's really great. You have mentioned, first a client or an investor need to know his risk profile.
Yeah.
He need to know that how much appetite he is there in terms of investing into this particular market. I personally feel few other factors are also playing very, very important role. You have mentioned age related factor also. But before age, the important factor is that your money is for how much time horizon. Because the longevity of the money, you can work in a different way. If the money is available for a short period of time, it's in a different way. So if you are talking about a size of a comparatively, I can say small investor where the money investment is there between 1 to 10 lakhs rupee. There are different asset class which are available, but we need to consider first the risk profiling part, which is very, very important, and that's playing a significant role. Second important part in any investment scheme, the asset allocation is also playing a very important role, because anybody who is investing money, he required to see that whether the right asset allocation has been done or not. Even for, I am talking about a person who want to invest only 10 lakhs rupees, then also asset allocation is playing an important role. Because any person who is investing, first he need to see how much money he can invest for long term. And for long term, equity always suits to the requirement, considering he required to achieve a particular growth related goal, and at the same time he doesn't require the money in short term, then he can very well put money into the equity side. When it comes to the keeping the money for the short term, then he requires debt rather than going into the equity side. Then third side, I can say it is asset allocation, which part I have mentioned. So if an investor, suppose an investor who is having an age of, I can say 25 to 30, in that particular case, he can surely invest for long-term horizon. That is the first thing. He doesn't require the money on immediate basis, and his requirement is also there for a long-term goal or something. So we also need to define the different goals based on the different time horizon. In that particular thing, if a person who is investing into this particular bracket, I can say he can put in tentative basis based on his risk profiling 60 to 70% money into equity side, almost 20% kind of money, 15 to 20% into debt related products. In terms of precious metal, always we keep on talking about 5 to 10% money people should keep into these asset class, which will provide him hedge against the inflation. Because ultimately FDs and those products are not beating your inflation. Those are just, I can say 1 to 2% below than the inflation rate. When we are talking about these precious metals, those are able to beat the inflation. And when we are talking about equity, on a long-term basis, equity were able to give 14 to 15% kind of return. So my advice is, even a person who want to invest even between 5 to 10 lakhs rupee also, he need to see from these different, I can say, asset class based on the asset allocation.
One follow-up question, you mentioned 5 to 10% in gold. But honestly, if you look at an Indian household today, there is a disproportionate amount of gold. I mean, our grandmothers and our forefathers have traditional gold, and it gets passed on, ancestrally. Is that also considered as my investment in gold?
Anything which is for your personal utilization, then it can't be treated as like your investment.
Okay.
But if you are keeping it as a completely separate like gold coin or something, then that can surely be treated as your investment. It's the same thing is applicable in case of real estate. You were talking about the precious metal. I am talking about even in real estate side also.
True.
If you are staying in a particular house and you are counting it as in your investment, no, it's not your investment. But if you are having any additional house which is not for your personal use, then that can be treated as your investment. So you need to segregate between these two asset class by that way. You have very rightly mentioned that earlier our grandfathers, or I can say the people, they were keeping the too much money into gold because at that point of time investment avenues were comparatively too less. The faith in the systems were also comparatively less. Gradually, now with the lots of things has been regulated and now things are changed in a big way. Liquidity is also far more in any asset class in which you are investing. You can liquidate your money within 1 to 2 days. So that's the advantage which are there. Earlier, gold, the money was kept into gold because gold was also treated like that. Whenever you require money, you could have liquidated it within a day also.
I think the phenomena of financialization of savings, as we call it, there's money moving from physical assets to financial assets. Okay, I want to go a notch higher in terms of income levels because then the profile of the person as well changes. Let's talk about those investors who have an investable amount of between 10 lakhs and 1 crore. I know this is a very broad range, but let's talk about a bit higher. Let's say post 50 lakh rupees. These are people who naturally, considering their higher investable surplus, would also be having higher incomes. Thus, perhaps their risk appetite also might be a bit more. Would your asset allocation change? Would your products recommended change?
You have rightly mentioned that once a person is going above a particular level, automatically the strengthening is there in terms of risk profiling or other thing. His tolerance power in terms of losing money or something, that also increases above a particular level. His return expectations also, generally it has been observed a person who is having lesser money, generally they are intending to go for a comparatively high returns related scenario. Once person is reaching above a particular level, the situation is changing and they are expecting a reasonable kind of return. Asset allocation will come into the picture there also. Risk profiling will come into the picture there also, because there is a possibility a person who is having just 10 lakhs and is ready to lose out of that particular money 1 lakh, 2 lakh, 3 lakhs, and there is other side the person who is having even 1 crore money but he don't want to lose even his 1 lakh rupee also out of that. So that is playing a very important role before deciding the investment related thing. But again, as I have mentioned, asset allocation will come here also into the picture. If you will say there will be a major change in terms of asset allocation into this particular class, I will say no, it will not change beyond a particular point. It will change more from the risk profiling point of view, but at the same time product basket will change, because then the person will have access to the other products like I have mentioned PMS, which is there, which is not applicable for a person with a 10 lakhs rupee. PMS is again regulated by the SEBI, okay, under a separate PMS related regulations. The important part here, the minimum requirement of the money into PMS investment is 50 lakhs. So here a person who is having 1 crore or plus kind of money, he can surely invest into 50 lakhs rupee towards this particular PMS. So products are available. Structure product which I have mentioned, the Nifty link structure, which are doing sometime balancing between your debt and equity. There again the people can invest because there also the requirement is there of the minimum 1 crore investments. So there are multiple products which will be available once persons are reaching above a particular level. But overall, first primary source which are there, that is the risk profiling and asset allocation, those will play again an important role here also.
It's a very interesting point you mentioned about how the personality of an individual as well changes, from when they were earning lower to now as they are earning higher. Perhaps there's this sense of preservation of wealth that kicks in rather than wealth growth. I want to take forward your point you mentioned on PMS. It's a very interesting product, and of course you have that minimum cutoff or a ticket size of 50 lakh rupees. Could you share with our viewers what exactly is it about PMS? Where does it invest? What's the structure like? And the risk reward ratio. So first you have already mentioned, it's the size which is the 50 lakhs. So that itself restricts any small investor to come into this particular product. Because ultimately you are giving your money somebody else to manage. PMS is managed by the fund manager, who are approved again by the regulator based on clearance of the certain exams. There is a prescribed exams which are there.
fund manager invest money based on their discretion, and that money is done in terms of investment in a separate DP account, which is separate for each customer, but yeah, it's kept. And in that particular investment related thing, fund manager charges a particular charge also into that particular thing. Fund manager can invest into stocks also, direct stocks. Fund manager can invest into mutual funds also. Fund manager can invest into liquid money also, for the time being parking money into liquid money. So different asset class can be invested by PMS fund manager based on the regulatory whatever applicability is there. And at the same time, it's based on the scheme on which he is working. He need to upfront define in that particular scheme which are the products which will be available. Even a PMS can be created only on the ETFs also. Okay, so different kind of products can be there in terms of investment into that particular scheme, but that is on the basis of the PMS fund manager discretion. That's how these things are working. And any point of time, person can add more money into that particular PMS. If money is going in terms of value side down because of market change, yes, it can go down, but person can't withdraw if his money is there only 50 lakhs and he want to withdraw partial money, he will not able to, because money can't go below 50 lakhs into any particular PMS. But if person want to withdraw out of, I can say, more money and want to keep it up to 50, yes, he can do. He want to withdraw full money, he can very well do that particular part. And from the regulatory side, few changes has been done in recent parts. Earlier, upfront commission was charged in case of the PMS. Now it's all on the trail basis, where somebody can charge on quarterly basis the trail revenue. So it can't be charged upfront for a full year or something. It's not possible now. So lots of regulation came into this particular picture. The risk reward side, which you have asked the other question, comparatively, since majorly the PMS investments are there into direct equity, comparatively I can say it's a risk which is associated with the direct equity, whatever is there, that is associated here also. But at the same time, the advantage is there. Fund managers are taking decisions, so they are taking comparatively informed decision, where they are doing their own research, they are having their own expertise, and based on that, they are able to control the risk also, or able to reduce the risk part also by doing their core expertise towards that.
All right, okay. So in a way, it's also about your money getting locked in, and investors need to be aware of that as well. Am I right? I
will say it's not locked in. He has, of any point of time, if he want to withdraw, he can give his instruction and he can withdraw it. I have mentioned that if he is investing 50 lakhs only, and out of that, if he want to withdraw partial money, then there is a challenge.
Understood.
If he want to withdraw full money, he can very well withdraw. It's at his own discretion.
So just hypothetically, I put in 50 lakh rupees today. I can literally go tomorrow and withdraw that 50 lakh rupees as well.
You can withdraw for any emergency, but otherwise, always, as I mentioned earlier also, equity investment, anything you want to do, it's for long term, it's not for short term.
Of course, of course. All right, okay. Let's talk about this umbrella of wealth management services. Firstly, what all does it entail? And secondly, at what stage in an investor's life do you think they need to attain wealth management services or procure wealth management services?
Wealth management services, I will say it's a providing the customized solution based on the client's overall requirement of long-term goal. If any client want to do his long-term future planning related to the financial assets, at the same time, client can also create planning related to his asset transfer even post his, I can say, death also. So client can plan in full-fledged way, and for those sort of services where clients would like to attain his financial goal with reducing the risk-related part, if he want to do, he can go with the wealth manager. There are different wealth managers who are managing wealth at a different, I can say, level of the total asset value. Logically speaking, any wealth management solution, ultimately, it should be set, I can say, in a manner where it should satisfy the client's real way long-term goal. That is the first requirement. Second thing, client should have, if you will say in terms of money, at the first level, I can say at least he should have bare minimum 1 crore to start with. The other important part, if any client who is not able to manage his money at his own, because I believe in that doing investment, it's sort of a business. It's not just a, I can say, side activity. Somebody who can do his investment at his own, whether he is able to see it on regular basis. When I'm talking about regular basis, I'm not talking about day to day. but at least somebody should review his portfolio after every 3 months to 6 months. If he is not having that particular, I can say, knowledge which can continuously be, I can say, utilized in form of review, my suggestion is he should go for the advisor or wealth management. Okay, so wealth management services or advisor, both these type of, I can say, services, he can very well go for those services. I would like to add few more points. As I have mentioned, this is related to the business related thing. Investment is business. I want to link few things here which will be very interesting for the, I can say, common man or the investors. In business, people are investing money for long term. When sometimes people are coming into this particular market, they are looking for short term. Logically, that's not a right approach, especially into equity side. But person can very well invest into that market for a short term, but equity investment, it's linked with the business. Ultimately, you are investing into a business. The second important thing which is there, when you are investing into any business, if you are into profit, you are generally putting more money into business. But the real way clients are doing generally reverse of that particular thing. When they are earning short profit, I can say limited profits, they are immediately booking it in short term. If that business is doing good, there is no need to withdraw the money. So that is the second important thing. Third important thing, whenever you are putting money into any business, you would also like to review that particular business on continued basis, and you want to have a continued update related to that particular business. So you should have that particular knowledge. If you are not able to track that business on continued basis, then my suggestion again, go for the advisor who can track your business. So these things are similar in terms of business as well as into investment side.
So investing in equity markets requires them to think like a business owner in many ways.
Absolutely right.
Okay. You know, we want to talk a lot to our younger investors, and that's the reason why we at Money TV as well speak to seasonal experts like you, so that they can learn from market veterans like you. So we try to do that. We try to educate young investors at Money TV and through our educational series. But I'd like to understand from you as well that somebody who's young and wants to learn more about the markets, what should they look at? Where should they go?
You have mentioned a question which is really applicable today almost with 80% of the population I am talking about. Because in recent past, in last 4 years, the total number of Demat account has increased like anything. Today, unique number of clients are almost 11 crore plus into this particular industry, right? And when we are talking about this sort of investor, yes, they require lots of clarity in terms of their investment. First and foremost, one tip I want to give, avoid tips. Okay, that is very, very important. The second important point, they need to actually go through the detail of the balance sheet. That is the financial statement, balance sheet, profit and loss, and cash flow. Many people, or I can say many new investors might not have those knowledge or going into those details. The people who are there into commerce side, they will able to go more into those details. The people into, I can say, the other aspects, it will be difficult. So there, my suggestion is they can take help of the advisor. They can go with the research advice of the different, I can say, broking houses or mutual fund. They can also put money into mutual fund. Their mutual fund, I can say, the fund managers are working for them. If they will do that through that particular route, comparatively, they will able to have better management of their investments. Okay, and one more important thing which I already mentioned, it's for a long-term investment. If you are putting, then it should be for long-term. Other important aspect which is also very, very important, where you have also mentioned earlier, that is the risk profiling. They need to do for themselves in terms of how exactly they want to grow their money, whether it's for a specific financial goal or they are putting investment without any goal. Logically speaking, there should be a clear-cut goal, what exactly they want to achieve. So those exercises should be done upfront. They should not treat it just as I have mentioned, it's a money if they are putting and they are playing with that particular money. I suggest them to avoid speculation. Derivative, they can work if they have knowledge and they can use it as a hedging tool. Otherwise, I will suggest them to avoid the derivative segment also, because at the early age, it's difficult to go into, I can say, easy entry, but you will able to lose your money comparatively in a much faster way. So these are few of the advice I would like to convey it to the fresh investors, or I can say the young age population.
And all advice clearly that they need to hear, because the way we are seeing things move, there is a lot of interest in speculation and trading and derivatives, when actually, like you mentioned, you should be thinking like a business owner. So tell me, Mr. Bhootra, when you're not thinking about markets and when you're not thinking about, stocks, what exactly is it that you enjoy doing?
I enjoy one important thing, that is the morning walk. I surely enjoy that part.
Yeah.
On every Sunday, I play cricket. So those sort of things which are giving me really, I can say, good. And one more important thing which I keep on doing, but still struggling toward that, but that is very, very necessary. That is the reading and upgrading the knowledge on continued basis. Learning should never stop. I found that despite I have spent in, I can say, almost 30 years in this particular financial market field, still I am learning day to day something new, and I am finding still I am a fresh student here. That is the overall thing.
Any interesting books you read from which you think you had a lot of takeaways and that still stays with you?
Yeah, there are, I can say, Rich Dad Poor Dad. I might have read it 3-4 times. Okay. There are other books also. And most important, how you can manage your time well. That's also a very, very critical aspect.
All right, Mr. Bhootra, it was great having you with us, and I'm sure that investors at all stages of life have learned a lot from this conversation.
Thanks a lot, Mobina, and thanks to Money TV for providing me this particular opportunity. I am sure that from Money TV also, lots of investors will get continued basis education. Thanks.
Well, that's always our objective. And thank you so much, viewers, for watching. This brings us to the end of this episode. If you liked it, don't forget to hit the button and subscribe to Money TV.
Investments are subject to market risks. Read all the related documents carefully before investing.